We've been talking about perceived versus actual value. I'm going to talk today about what model is better. When it comes to value, let's look at the variables. Start off with a high perceived value and a low actual value. Looks great, but delivers poorly. Short term, what happens? It's easier to sell, faster decisions, less initial resistance. Long-term reality, though, is trust erodes quickly. Refunds, churns, complaints increase. Referrals disappear. Reputation damage follows. The model always collapses over time. You can't outmarket bad delivery. This is common with cheap costs, big promises, and fast-saving pitches. What's the next variable? Low perceived value, high actual value. Undersold, overdeliver. Short term, it's harder to close. It takes a lot longer in the sales cycle. Price resistance. The long-term reality, though, is you are building strong trust with your clients. High retention rates, referrals increase. Clients become advocates. The model is operationally very healthy long-term. Short-term becomes a real challenge because it is commercially inefficient. Many companies, service companies, consultants, professional service firms live here. They deliver real value but fail to communicate it. So what's the best position? Well, surprisingly enough, aligned value. Perceived value equals actual value. The strongest businesses slightly under-promise, considering or consistently over-deliver, clearly explain outcomes, prove results with data and examples. So this creates easier sales, fewer objections, strong margins, and long-term relationships, which is what you're trying to build. Bottom line, if you had to choose between the two, lower perceived value and higher actual value is always better because perception can be fixed. Broken promises or broken trust cannot. The real work isn't inflating perceived value, it's closing the gap by clearly explaining and proving the actual value you already deliver.